Liquidity will just simply follow the popularity and success or not. If things are successful, liquidity always follows. People will pile in. And we'll have the usual cycle. Too many people will pile in at some point. Not yet. We're really at a very low point still, just coming uphill a bit. Private equity in demand for refinancings is a large driver of business for leveraged loan type CLOs and most senior debt. There's still an enormous wall of that coming up in the next few years, so it's a big component of what comes forward. The underlying loan demand is high, and as we'll come back to later, banks aren't in a great shape to actually provide those loans. Private equity fundraising, however, is really at an incredible low. It's the lowest it's been since 2003. There's a lot of money in the funds. There's an awful lot of companies in the portfolios. So it's not vanishing in a puff of smoke or anything. But as a long-term predictor, private equity is probably going to end up as a somewhat smaller asset class than it was in 2005-08. And it'll stabilize, if stabilization is the right word, at a lower level. Take a long time. Dynamics of those 10-year funds mean it takes a long time for things to actually change size. But there's lots of money to deploy, and there's still not a lot of banking around. Banks remain incredibly fragile in most countries. So, CLOs and leveraged loans. Everybody was scared witless a couple of years ago, 3 years ago. We were going to have massive losses. And we didn't. In fact, most of the people in this room who were around at that time were huge beneficiaries of something that really was inconceivable. Things were worse than they could possibly imagine, and that saved their bacon. The risks in the entire economic system were so large that we couldn't allow failure to occur. So kicking the can down the road, extend and pretend, low interest rates, all that lot came to the fore at once. And what looked to be ridiculous financial structures by any historical standard survived for long periods as quantitative easing and low interest rates did it. That's what happened to default rates in one market. They all looked broadly the same. They went up and they came hurtling back down again. Back to historical norms? Don't think so. Back to a low level. So it's all about pain aversion. Western world's economic policy is most easily rationalized by assuming that governments will take whatever action generates the least short-term pain. That's true of the vast majority of Western economies and will result in, at some stage, there being a great deal more pain because you can't keep deferring the problems of too much debt with more debt. Eventually, that game comes to an end. So who controls interest rates going forward? Well, Bank of England, ECB, Fed. Short term, yeah. Long term, no. They don't. This is one of many, many similar curves which most of you will have seen as the Western world jacks up its debt. I can put up a string of alarming charts showing you that the US, basically, if it keeps its tax regime where it is somewhere around about 2020, it pays for Social Security and the interest on its debt and nothing else. We see that similarly across Europe. Virtually every country in Europe is operating at somewhere north of 6% deficits, probably 3 times reasonable growth rates for most of those economies. Everything is stacking up debt. Now, that breaks at some point. If you're a believer in historical norms, look at that chart and decide where the historical norm should lie. It ain't going to keep on going up. The US needs to do something mind-boggling to get its finances in order. It needs to reduce its expenditure in the next decade by something like $15 trillion, which is a big number even for a CLO conference. It's an absolutely mind-boggling position. Now, nobody seems to recognize that this issue comes, but at some stage, our financial system's under immense pressure. We can't keep fishing this lot out. The Irish can't be fished out. So what's going to happen? We could have interest rates driven by a string of defaults, possibly just one, who knows. As soon as the markets start to distrust sovereign debt, interest rates rise without any ability of the central banks to affect that, save massive printing of money, which of course has its other effects. So this is the background you're all playing against, whatever you do over the years ahead. These could go over. Inflationary expectations will rise. It's a nice quote from the great economist. I like the line at the end of it, which only one man in a million is able to understand the way that governments evaporate currencies. I was looking at it the other day. Since I left university, the UK pound has actually diminished in value by a factor of 14. It really brought it home to me. I didn't think it was that much, but it really is that much. Credit creation, nowadays known as quantitative easing, previously thought to be a treatment for hemorrhoids. If it's not backed by wealth creation, generates inflation, always. Only the timing of the inflation is uncertain. You can't get away from the fact that if there's an excess of the stuff, prices rise. And higher rates would still be devastatingly bad for much of the existing CLO base and many of the leveraged loans. Refinancing is quite feasible when rates are very low, but if rates went back to the average of the last 30 years, many of the leveraged buyouts would find refinancing virtually impossible. I'm not clever enough to tell you when interest rates rise, but they will rise at some point. And if they do, it'd be very, very bad for this industry on its historic heaps. You'd see very poor returns on the equity tranches and possibly worse. Then I put a little odd point there, something which is quite bizarre. The pricing of LBOs, the deals themselves, turns out to be poorly correlated to stock exchange levels, poorly correlated to credit market conditions. It actually correlates best to the inverse of the interest rate. So high rates mean low prices for buyouts, which also mean, again, great difficulties in refinancing as the enterprise values will drop below the debt. So there's quite a serious set of issues here. Interest rates move. It's not, a trickle. It's a really big hit.